Well, folks, I usually only do reactions on my reaction channel, Jeremy Lefebvre Makes Money, but you know what? Today is a different day because this video is so dang big that I thought I have to react to this actually on the main channel here today. So that's exactly what we're going to do. The earnings recession is behind us. Time to take the equity risks, says JP Morgan's Gabriela Santos. I want to hear what she has to say, react to that, kind of share my opinions and perspectives on that. Then I want to go ahead and take you guys into some numbers for a company that just reported about an hour ago. And the numbers looked really great until you maybe dig a little bit deeper, and then you start to find a few kind of troubling things there. And so I want to talk about that in this video as well. Okay, so two subjects. I appreciate everybody joining me as always. Thanks so much for being subscribed, folks. Yeah, man. And by the way, thank you everybody that is subscribed over on the reaction channel. If you are subscribed over on the reaction channel and you usually watch that channel, let me know in the comments section, because I don't even know how much overlap these two channels have. But yeah, if you watch that channel religiously and you enjoy that channel, let me know in the comment section. I never know, like, well, how many people from the main channel are watching that channel versus vice versa and things like that. So anyways, guys, appreciate you being here, and yeah, let's go ahead and get into this. And also feel free to share your opinion in regards to anything she talks about here.
Your notes, and you say this is not necessarily the start of something worse once we hit the fall.
I think we've come a long way in a year and a half in terms of appreciating that the bear market is likely behind us, as we believe, and that we're back to seeing a normal period of volatility in equity markets from time to time. So a 5% pullback once a quarter, a 10% pullback once a year within a bull market, and that's where we think we are. Since late July, we think this is some good old-fashioned profit taking. You can really see that by the underperformance of those companies and sectors that had led before, whether it's large cap tech, semiconductors, home builders, or more recently even banks. So ultimately, how far this goes, we'll have to see. It's seasonally a weak period, and it'll very much depend on what happens with earnings and CPI in the weeks ahead. But ultimately, we still have a constructive view of stocks from here.
Okay, correct me if I'm wrong. You sound more positive on the market than you have been since we've been having these conversations.
Yes. And that is...
Okay, before she goes further here, okay, I think it's very important I kind of let you guys know something here. So she's obviously talking about the indexes, volatility, and kind of, you know, anybody that's newer to the market, just understand kind of like 5 to 10% pullbacks are pretty normal in the market. You're going to get those every year, sometimes multiple times per year, okay? So just keep that in mind. You're going to have some kind of violent moves upwards and downwards. It's a very normal market. But something I want everybody to keep in mind, it's very, very important in regards to this whole subject, is just because you are getting a period where there's not huge volatility in the indexes, you're not seeing you know, double-digit type moves, 15, 20%, 25%, do not let that market put you to sleep. Because I'm telling you, even in a market like that, you can get some insane, and I mean absolutely insane moves in many stocks. Look at the S&P 500 this year, for instance. Okay, let's go ahead and take a peek at the S&P 500, and this will illustrate this point very, very freaking well, okay? So let's pull it up here. Let's see, S&P 500, SPX here. Where are you at, baby? There you are. Okay, so the S&P 500 year to date is up 14%, right? Now, mind you, this 14% move for the S&P 500 has come with many stocks flying, you know, gosh, I mean, how many stocks have we seen go up 50% this year? 100% gains this year, 150% gains this year, even 200+% gains. It's a pretty big list of stocks that have, you know, obviously 3x, 4x, 5x, 10x the market this year, right? On the flip side, I can give you a long list of stocks that have absolutely crashed this year and have seen, you know, declines of 15, 20, 30, 40% in their stock prices this year. So when you're in a market like this, don't let it put you to sleep. There's a lot of action in there. There's a lot of, you know, hedging opportunities. There's a lot of buying opportunities. There's a lot of opportunities in any market. And sometimes these are the best markets you can possibly get because it's not just clear cut one way or another, like everything's going to the moon or everything's going to crash, okay? And remember, the 14% move, just remember, like a lot of that's just kind of like get back from last year. right? Because the S&P 500 obviously had a pretty ugly last year, although the NASDAQ got hit the worst.
Changed since the end of May, because we, like a lot of people, had come into this year expecting a hard landing, or it was always a conversation about a mild recession, but there was an expectation of a recession taking hold mid-year.
Okay, so this is maybe a little scary. So she was expecting, her team was expecting kind of a hard recession coming into the year. They were clearly bearish coming into the year, right? And since May, they flipped over to the positive side. Now, why did they flip over the positive side? Is it just like the economy holding together better, or is it the fact that the stock market absolutely went on an insane run from January to May, right? And these are the things you got to consider and kind of think about in regards to this, right?
Combined with margin pressure on the earnings side. And since then, we've had substantially better data on the macro front, showing a normalization of the labor market, but not a collapse. So that can still support positive consumption at the same time that we've had better data on the inflation front, especially June and July, super core increasing only 0.2%. We've also had better earnings data. If you exclude energy and materials, earnings actually grew in the second quarter. So we have now come around to this.
Something she's missing here, and this is a massive thing. She's missing this huge, okay? And this is where a lot of these folks made a huge mistake, right? They sold out of their positions. They went into this year super bearish. Some of them went into this year very shorted, very, let's call it just heavy on put options, things like that. Here's where they screwed up in a massive, massive way. The economy doesn't just magically change in a huge way in a 6-month span. It takes a year, sometimes several years, to really deteriorate the economy and kind of destroy it. On the flip side, if you want to go from a bad economy to a good economy, it takes years. It doesn't happen overnight. The economy is way too big. It's way too complicated to just be like, it's going to all go bad right now. It's all going to go good right now, right? It doesn't work like that unless you have a once in 100-year shutdown on the entire economy and the government says you can't do business. That's a whole different scenario, right? But outside of that, you can't have things just deteriorate like that. It doesn't work that way. All these Fed rate increases that they've been doing violently for a long time now, all the headwinds we're facing now at this point in time, the Fed lags always take 1 to 3 years. And this is something I wish these folks that, are supposed to be super experienced and they went to these prestigious schools, like this is like base level stuff. And they're just missing base level stuff. Like at the very earliest, Fed lags kick in 1 year after the Fed starts raising rates, okay? So if you expected everything to go to crap at the very beginning of this year, right? That would have been at the very beginning, you would have expected to start in March. That's a 1 year. But you're coming off of a very low unemployment, right? All that stimulus money, you're probably looking more toward 2 or 3 years, which means likely the hit comes in 2024 or 2025. And they all expected it to start right now. You know what I mean? This is why, you could go to these schools, you can have this diploma on your wall, and ultimately you're not going to have a house as big as mine.
Actually grew in the second quarter.
That was me.
So we have now come around to this view of a soft landing as the base case of the earnings recession being behind us, and for it making more sense to take on more risk on the equity side especially.
The problem with all of that, and it's all of course valid, is that what you've also gotten, higher yields. And that's been the picture of late, right? Since the start of earnings season to today, the yield on the 10-year is up 50 basis points. The market's clearly unsettled about where rates are. Stronger economy perhaps means higher yields than maybe we thought, and higher perhaps for longer than we want. What do we do with that?
I think our conversations with investors the past 2 weeks have been entirely about this move in long end yields, and there being a lot of confusion about why that's happening. And I think, first of all, it's been a sudden move, 60 basis points since mid-July, but it's also been the lack of clear understanding why. And if we translate that to stocks, not all reasons why yields go up are the same for stocks. Some are more positive than others.
So Santos said a strategy, invest in equal weight S&P 500, add duration in fixed income. Cash can be a dangerous place to be too overweight. Well, first off, that's a relative term, too overweight. What are we talking about there? Are we talking 10% cash, 30%, 50%? My personal opinion right now, in terms of cash levels, I would say definitely lean toward having very strong cash position right now. I would say at a minimum 10%, but I'm thinking more to 20 or 30%. I do think it's dangerous to be all in cash, but I think you should have a very healthy cash levels. I'm talking the most strong cash levels. You really want the most strong cash levels you probably had since, I would say, early 2021. That's the way I would put it. Right now, you can get 4 to 5% in your cash. Why wouldn't you want to hold cash? And understanding the risk and the ramifications of if the Fed lags catch up, right, and what that could mean for the real estate market, what that could mean for the stock market. Like, I think it's a very good time to have some cash around. Understanding, like, the employment picture doesn't get any better than this. We're at 3% unemployment right now. So, like, it only gets worse in terms of the employment picture. Like, it doesn't get better, right? So given the risks that are out there, I think everybody should have a very good cash position right now. I think it's a very intelligent time to have a very strong cash position. And I think if you're somebody sitting out there and you have no cash, I think you're setting up for a very difficult situation, unless you're somebody that, you're just getting started with investing, you're investing your first few $1,000s, something like that. It's a whole different scenario. I'm really talking about the people that have 6 figures, 7 figures, 8 figures in the market, right? For those folks, like, I think it's good to have some cash around, because there's a lot of problem children, let's just call it, in the stock market that are lurking out there and that are just kind of waiting. China, Taiwan, obviously you got Russia going on. You have the potential of what if we had another increase of inflation in 2024 in some sort of, substantial way. What would the Fed have to do and react to that? Recession, Fed lags catching up. I mean, there's just a lot of dang risk out there. So I think everybody should be holding some pretty dang good cash levels right now. I think if you get 4 or 5%, like why not hold some cash given the risks that are out there right now? And given the fact that it's not like the market's been decimated right now, right? In 2022, you had to be deploying and buying growth stocks. This year, I think, you can buy some of the divs, some of the values, and I think you can also cash up a little bit.
Driven by a fear of a no landing or a reacceleration that's inflationary. That's not good.
Well, but isn't that like a legit fear at this point?
We think that one is a bit overplayed, shall we say?
The no landing idea.
The no landing idea.
Too strong economy for everybody to handle.
For everybody to handle. First, if you look at break-evens, they've only moved higher 10 basis points, so it doesn't seem like it's really driven by higher inflation expectations. And then on the growth side, this idea that we're actually going to get third quarter GDP of 6% seems very, very unlikely. Historically, when the Atlanta Fed GDP now is over 4%, it usually at this point overestimates growth by 2 percentage points. We're still expecting a normalization of activity, especially consumption of services. That's a soft landing, not a no landing.
Okay. You need Jay Powell, the Fed chair, and his panel to be your friend from here on out, don't you? Right? I mean, in terms of Jackson Hole, a few days from now, what's the risk? The risk is that he's more hawkish than the market's willing to accept, right?
I think more recently, there's been an interesting conversation that's taking place. Rather than about the no landing fears, it's migrated into a conversation about R-star. So what is, in today's economy, a neutral real rate? And I think that's where there's an expectation there could be some interesting academic papers published at Jackson Hole. So we'll be reading those on Friday and over the weekend. And really, it's about why our star could be higher. Is it because we've gotten better news on productivity? That's a good thing, actually, for stocks. Mm-hmm. And how high has that R star gone up?
So I think Gabrielle is kind of missing the point here, okay? Scott there, he basically wants to know more about how would the commentary be specific in regards to Jay Powell. Is he going to be ultra hawkish, ultra dovish? What's his perspective? So my opinion on this is, I don't think, honestly, the Fed and Jerome Powell could get much more damn hawkish than they've been over the past several months now at this point in time. So I think they're pretty much maxed out level hawkishness. He could definitely say we're not going to raise rates. We're not going to, they might still raise rates. What he could say is we're not going to consider cutting rates anytime soon. Well, he's already kind of said that several times now at this point in time. So if he said, hey, we're not cutting rates anytime soon, yeah, okay, that's pretty much what he's already been saying. He's going to probably leave the door open to future rate increases. That's really nothing new. He's not going to say we've defeated inflation yet, especially with a month-over-month increase that we saw last month. So he's going to come in likely hawkish, but I mean, at the end of the day, I don't know if he can get much more than he's already done. So actually, I think there's a little short-term risk to the upside from kind of that perspective, because I don't think you can really go any more violently that way than they've honestly already gone. So that's kind of my 2 cents on that.
50 basis points real rates to 200, that seems very sudden. So we really think it's just marginally higher, and that's an environment that stocks can do quite well, actually.
I know, but what if we thought what was the neutral rate was a good place to be? The stronger economic growth that you rightfully cite suggests that the neutral rate isn't high enough.
I think what we're really expecting for the second half of the year is okay growth. So I think we get asked, is good news bad news? Is bad news good news? Okay news is good news. So it's really a story of normalization in growth, a little bit sub-trend, a little bit below 2%. Mm-hmm. Higher rates are still having an impact, and rates at nearly 5.5% are still way too restrictive, given that implies a 200 basis point real rate. So we can see rate cuts even in a soft landing scenario.
Is that your playbook? You think we're going to get rate cuts? And if so, when?
We do, and I think it's less about a mispricing for 2024. The Fed's likely going to take its time next year. 100 basis points sounds fair. It's more about the estimate for 2025, which by the end of 2025, investors are pricing in rates at 4%. That's that 200 basis point real rate that to us doesn't make sense. Settling in something closer to 50 to 100 basis points real rates, or rates closer to 3%, seems more reasonable. And that's why we've been advocating for adding duration as a nice hedge also against that more positive equity view.
So I'm going to tell you guys before we get into this earnings that just came out about an hour ago, and I share my perspective there. Let me tell you about the worst case scenario, okay? I'll tell you about the worst case scenario. This is, we'll call this the MAV scenario, okay? The MAV scenario is one in which the economy still doesn't fall into recession over the next several quarters. We see inflation rates going back higher again in 2024. The Fed has to then come along and start hitting interest rates again in 2024, even higher, while the consumer's in a much weaker place than they were, let's say, when the Fed started raising rates the first time at the beginning of 2022, right? Because the consumer was in a much better place at that time. Now, the consumer's obviously been damaged by inflation for, pretty much a year and a half, if not 2 years. So if you have to then start raising interest rates more in 2024, you're doing that into an economy that's in a much weaker place, companies that are in a much weaker place, and a consumer that's in a much weaker place. That's the ultimate problem into stagflation, into a much heavier, deeper, darker recession than if you just had to get over with at the first time. Let's just call it that. And that is kind of the doomsday scenario around the economy, around inflation, around what the Fed has to do, and then that can make, obviously, 2024 into 2025 a very ugly, ugly time. So if anything, you'd almost rather have a smaller recession, shorter term. It kills down inflation down to, back down the 2% type level. It weakens the employment market, so you kind of get out of this whole wage inflation problems we had and the price wage spiral we've been in. And then you just get it out of the way. And then the Fed can make a decision at that time to potentially lower rates, not all the way down to zero, but they could lower them down to maybe 2.5%, something like that, 2%. And then maybe you can start sliding the economy back a little positive at the end of 24 or into 2025, right? So those are some scenarios we got to play with here in regards to this whole situation, okay? Now, Toll Brothers just reported earnings, okay, about an hour ago or so. Now, it's interesting with these Toll Brother earnings, and I think all these home builders want to keep an eye on them over this next several quarters, okay? So in regards to their numbers for this past quarter, phenomenal. Home sales are phenomenal. Revenue, phenomenal. In terms of gross margins, phenomenal. $742 million of gross margin from home sales versus $585 in the same quarter last year. Selling general administrative, that's impressive. They kept that line in check in a phenomenal way. They actually went down year over year. That's freaking amazing, okay? Income from operations exploded higher to $515 million from $361 million. Net income exploded to $414 million versus $273 million in the same quarter last year. Diluted EPS went to $3.73 from $2.35. So at first glance, it looks like, oh my gosh, Toll Brothers is knocking the cover off the ball. flip and flapjack and amazing, okay? You start to look a little deeper and you start to find a few troubling things, okay? So the first one that's still positive, and then we'll get into the more troubling one, is contracts, right? Contracts came in strong in the north. Contracts came in strong in the mid-Atlantic. Contracts came in strong in the south, the mountain region, and the Pacific region in terms of signed contracts. That's all really good, okay? But the problem is, in this particular quarter, since this particular quarter, ended, right, which this quarter ended July 31st, interest rates have gone up even higher than they were during like May, June, in July, right, in terms of mortgage rates. So that's hit the market. And guess what else has happened? The stock market has started getting hit now at this point in time, which definitely dampens the sentiment for a Toll Brothers buyer. It's a more sophisticated buyer, and they're very much more in tune with what's going on. And a lot of these folks were feeling pretty dang good in May and June when the stock market had just been on a insane kind of 7-8 month roar. And now things have started to weaken. Mortgage rates are high, the highest they've been in, I think, like 23 years now at this point in time, right? Several decades. And so the problem is contracts could, let's just call it, be in a tougher place over the next several quarters, right? Now, in terms of backlog, this is where things get troubling. Their backlog in the north is down substantially, from 1,500 units to just over 1,000. Mid-Atlantic is literally about the same. South, 2,400 units of backlog versus almost 3,000 the same quarter last year. Mountains down substantially, 1,867. Basically in the backlog for homes, right? That's versus 3,400 in the same quarter last year. Pacific, 915 homes under contract right now versus 1,700. The problem with this is the contract volumes, the backlog continues to be in a weaker and weaker place. And we haven't even really seen sales get hit that hard yet, right? Now imagine a scenario where you actually have a recession, unemployment going up, a stock market that continues to weaken. Let's just say that was a hypothetical that happens. Do you know what's going to happen to backlogs? They're going to shrink in a much more substantial way, right? Then you run into scenarios where if there's some sort of credit crunch, you could obviously have people cancel their homes, things like that. So the stock price is making such a muted move after hours, right? And I wrote this. I said, strong spring selling season foretold. Not so sure will hold into the fall and winter with weakness starting in the stock market and mortgage rates blasting higher. Backlog is shrinking considerably, right? And so I don't know. We'll see how all that plays out. But, when it comes to these home builders, they kind of have the feeling of like, this is as good as it gets. It only gets worse from here for kind of that whole group. And especially, some of these guys at the higher end. So we'll see how it all plays out. It will be what it's going to be. And I'll cover it for you guys. I appreciate you joining me as always. Thanks so much for being here. Thanks for being subscribed. A little bit of a different video here today on the main channel. Hope you guys enjoyed it. If you're looking to apply to join my private group, get access to the private Discord chat, all my course curriculums, things like that, and then check out the pinned comment down there. Much love and have a great day.